Hey everybody, welcome to the Accounting 240 Week 5 virtual meeting. Here we are. So exciting. What are we going to talk about this week? It's property income. So I'll do like a limited series of quote unquote lectures where I effectively read through the PowerPoints that I already prepared and you could have watched already. And then if we have time, I'll walk through some examples from the course pack. Now, just as a reminder, Kathy Ross, I believe, has a video for like every single problem in the course pack. So those are up there already. And I remember somebody last week told me they were checking them out and they were super helpful. So that's awesome. I'm glad Kathy's doing those because I'm not going to lie, I don't have the time that I would like to do those. Hopefully that's working out for people. Okay. And then I've got my lecture videos here. I'll make a few more of those for you guys as I see that they are necessary. And I haven't had any requests to do a specific problem and walk through that via video. If I were to get a request like that, I could definitely do that, but I don't know what it is that people want. So get on the discussion board, make some noise, clamor for some kind of specific recording, and then I can definitely do that for you guys if that's something that you're interested in, okay? I'm here for you guys. I just don't know what you need from me, okay? I'm trying to answer the message board questions as soon as I see them. Sometimes I don't see them because people are constantly thanking me for things. You don't have to thank me for answering your discussion board emails. It's fine, I get it. So cool, let's get started on what we're gonna be doing today, which is I'm gonna show screen action here. It is, can you guys see it? I don't know what you can see now. Can you see the slideshow? Let me know if you can see the slideshow. I'm gonna find the chat window. Boom, chat. I'm gonna guess we can. Okay, Amrita, thank you. Thanks, Tristan. That's great, guys. So let's get on to property income. At the end of whatever we do today, I'll spend a few minutes answering any questions you guys want, hopefully clearing up any confusion. So again, these are all pre-filmed. So if you are, and this is filmed, so you can go back and watch this if you have some confusing questions about the whole thing. So here we go. That's me again. Oh my God, you can see how badly I've aged. So here we go. So property income, here's some learning objectives for you guys. Okay, so we're gonna define property income, hopefully distinguish it from business income. I can do that with basically one sentence, so you can know the difference between property and business income. It's fairly straightforward. Various types of property income. Oh, good. Okay, I'd also like to be able to distinguish between property income and capital gains. Those two things are not the same thing, although students quite frequently think that if you buy a thing and sell it for a higher price, that's property income. No, it's not. There are 5 kinds of income. We haven't really covered this. Oh, Kathy made a video on the 5 kinds of income. I'll post that like the second I'm done. Let me write it down. 5 types of income vid. Rockin'. Okay, so we're going to talk specifically today about property income. All right, there's various types, but there's only really like 3 types that you guys are ever going to care about in my tax courses. We're going to talk about the tax treatments for different kinds of dividends. We're going to determine net rental income for a taxpayer. It's not hard. And calculate the capital cost allowance for rental properties in UCC. Rental properties have some slightly different rules associated with them. And we're going to walk through those, okay? Cheers. Eggnog latte, guys. It's the season for eggnog lattes. They sell it at the store already. Okay. Whatever, dude. If they got eggnog, I'm buying it. I don't care. All right, so it's like a meal replacement system. So, guys, we are here in our, this is what we call the aggregate formula, if you want to call it that. You don't have to call it that, but it's where we aggregate our net income. So where are we in here? I can never see the little pen. Here's the little pen. This is us, guys. We're still figuring out positive sources of net income. That's what we've got here. It's non-capital positive sources of income. Capital being, I got capital gains or whatever, that's over here. But we're not doing that today. Notice how capital gains and property income are totally in different sections. It's because capital gains are not property income. Here are the 4. There's 1, 2, 3, 4 types of income over here, and this is the 5th over here, right? We've got 5 types of income. So we're going to focus on property income today. Hey, guess what? If you go down to this section down here, property losses. Okay, is it possible to have negative amounts of property income? Yeah, that's why it's here. That's why I wrote it down. For sure, you can have a property loss, right? Let's say you got a rental property and then you got $10,000 of rents for the year, and you got $40,000 worth of expenses. Oh, guess what? You got a property loss. Not hard. There are other ways that property losses can arise. We may talk about a few of those things as the class progresses. Questions so far? I doubt it. Are there questions so far? Just focused on property income, guys. We're not even really talking about capital gains here at all. I just want you to know that they're not capital gains. All right. There is a whole segment that we'll do on capital gains. So what's next? Okay. So property income, it's a return on capital, whereby here's how you earn income. You own property and you let somebody else use it. And then they just pay you for the use of your property. You maybe never have thought about it like this before, but this is the way that it works. So for example, here are some types of, well, let's see what else. So the return can be annual, or the return is on like sort of a regular basis, like rental income, for example, that's property. So for example, you own a rental building, or you just have an extra suite, excuse me, in your apartment. That's the property you own. And then passively, somebody lives there, right? Well, they're active, but you just sit back and let the rents roll in. That's considered passive income, right? Same thing with if you own shares of stock, okay? If you own shares of stock, what's the kind of property income you receive? That's dividends, right? That's a distribution of the retained earnings of that corporation to you, the owner, right? The property you own is a share of that corporation. The property income is the dividend. Likewise with interest, what do you own? Well, you own, let's say, a bond, right? You're owning bonds that are issued by, I don't know, federal government or the government of Greece or whoever's, some corporations issue bonds, fine, right? Financial institutions issue bonds. The property that you own is the bond, and then the property income is the interest. Also, if you just put money in the bank, the property that you own that somebody else is using is money, right? Do you think the bank just has all your money sitting there? Like it's in like a vault somewhere, like it used to be when you would see when you see like a heist, like the Ocean's 11 guys are doing a heist and there's all this money in there. No, the bank is using your money for other things, right? If every single person, like individual who had money in the bank went into the bank at the same time and asked for their money, they wouldn't get it. They don't have that kind of money on hand, right? But you're basically letting the bank use your money, and they're paying you like a paltry amount of interest for that privilege. My advice, don't ever even have a savings account. Maybe you can have like a float in there of $1,000 or something like that. But all the rest of your money, just buy stock in the bank. They'll pay you dividends. The stock will go up in value. It's just way better. If you need the money, just sell it. Big deal. It's so easy. Anyway, I'm not here to provide financial advice, just teach you about tax. So the deal with property income is that you're not spending any time or very little time. It's passive income, right? I buy shares of stock, and then guess what? I just sit back and dividends flow in. I got like a little trading account, guys. And sometimes I look at it every day just to see where I'm at on a daily basis. And then sometimes the cash account is just mysteriously bigger. But I know why it's bigger, because I got dividends. Did I do anything? I did jack squat. I just bought some shares in CIBC. 7% dividend yield, guys. I bought some shares in CIBC. I sit around, and every quarter they just give me money. That is passive income. You guys, as you get older, want to maximize your sources of passive income, money you get for doing nothing by letting somebody else use the property that you own. Same thing for rental income, right? I got a rental suite. Yeah, I got to put a little bit of effort into it. I got to make sure that I got nice paintings on the wall. I got to have like reasonable furniture. But as soon as somebody rents it, I don't really do anything. Sure, if something breaks down, I go in there. That is not considered actively managed income. Now, business income is the pursuit, right? Or an adventure or concern in the nature of trade. You're pursuing actively a profit, right? So if you're running a business, you are purchasing capital assets, you're buying inventory, you got a marketing team, you've got all sorts of expenses and related revenues, and it's different. That's active income, right? So property income, passive income. And the reason it's important to distinguish that isn't really that important in this class, other than you need to know it. But when you get to corporate tax, corporations who are in business income and property income, they're taxed way differently. Property income is taxed much higher in a corporation. So it's important that you know how to distinguish between those two things. I guess I talk a little fast, don't I? You know what you can do is just play this back, and can't you play it on like 0.8 times speed or something like that? Like I'm all jacked up on friggin' eggnog lattes. What do you want? So another example, like the same thing with interest, right? Passively earned, passive process. There it is. So how do you generally determine what your net property income is? Well, take a look at all your property revenue, right? Dividends, interest, whatever, and then subtract related expenses. That's your net property income, right? Do you have expenses associated with property income? You bet you do, but we'll talk about those. This is only the first slide, all right? Notice how over on the slide here, I've distinctively said, how did I do this? That's really poor. It's a poor diagram, but property income is not capital gain or loss, period. Okay, please, please. I meet CPAs who think that these things are the same thing. They're not the same thing. All right, so here are the major types of property income. So interest that I talked about, right? You know, you loan someone money, you get interest. You put money in the bank, you get interest. You buy a bond, you get interest. There's a whole video on interest. Maybe we'll get to it today. I don't know. Dividends. So also, and then rental income. Okay, real estate or other tangible property. I mean, it says cars or machinery. Sure, you can rent your car out, like taxi fleets sometimes. I don't know if people own their own taxis. There are people who like own half a taxi, or they own a taxi and they let somebody else use it. And then they pay for the privilege of using that taxi in addition to whatever fees they have to pay to like the taxi overlords who are real people. Okay, so royalties. Royalties if you own the rights to, I don't know, like a song, or you wrote a song or something like that. Every time the song gets played, like the work was writing the song, but after you're done, every time the song gets played, you get some money. If you star as like a voiceover artist in a cartoon or something like that, that'd be a fun job, right? Like an actor or something like that. A lot of actors get royalties too, where they appear in something, and then every time that cartoon gets played or whatever, they're going to get royalties. Things like patents and mineral rights, et cetera, like that. If you own this stuff and there's income coming in relative to that, you can potentially, you know, this is classified as property income. I will never ask you anything about royalties except some kind of multiple choice question. There's no like massive question I can ask you about royalties, and it's kind of confusing for people. This does not include capital gains as mentioned prior. Okay. So we determine property income or loss generally on an annual basis. That doesn't mean if it's coming in more frequently than that, you wouldn't record it. But at the end of the year, you're like, okay, well, what's my net property income so I can shove it into my tax return? So for individuals, the taxation year, as we know, is a calendar year. Calendar year meaning like a North American calendar year, which is January 1 through December 31. There are places where that's not the actual year, but that's not what we're dealing with here. We're dealing with Canadian income tax. So for corporations, I'll slow down now because this part's harder. The taxation year is what we call a fiscal period, all right? It does not coincide necessarily with a calendar year, although many corporations, the management of said corporation will choose to have a December 31 year end. And many, many, many corporations do, but many, many corporations don't. They'll have, for example, a June 30th year end. Or some corporations have this weird thing where they have like a 52-week year. Oh, you guys know 52 doesn't go evenly into 365, right? So every year their year end is slightly different. Why do they do that? Who cares? I've seen it once on an audit that I did once. It was for a co-op. I don't know. They got a weird business structure anyway. So fiscal period, okay? Please keep that in mind. I will say if there's a year end that's not a December 31st year end, and you got to be able to deal with that for tax purposes, okay? Okay. Let's see. So property income. Did I miss a slide? I don't know what the back button is. So I got to go over here and look for the little thingies. Sorry. Did I miss one? Nah, I didn't miss one. Good for me. Okay, so here we have, I'm just gonna slightly adjust this screen and I can see things a bit better. Okay, so if you do have a loss from property, right, an overall property loss, it goes in that far section of the aggregate formula. Remember in the aggregate formula, we've got like this thing, then this thing, then this thing, then this thing. First, we determine all our positive sources of income. But if we happen to have a loss, business loss or property loss, et cetera, right? By the time you get to that point, if you've got other sources of income, you can then deduct it against that. That's sort of what I mean. Oh, we have an example. That's nice. Oh, here we have Jessica Jones has business income of $50,000 for the year. That's great. And she also has loss from her rental property of $20,000. Her total NITP then, if this is all that she's got in the entire year, is going to be 30 grand, which you can see if you've practiced some of those questions from chapter 1. Okay, this shouldn't be a big surprise to anyone because there's a bunch of net income for tax purposes questions. I also have a comprehensive problem up there, and also Kathy walks through like 7 of them. So hopefully you guys are like cool with how this works, okay? You have to determine net property income for each individual property that you have, all right? So if you got some positive property income, that goes on the positive side. If you got some negative property, it should be the other way around. It goes on the negative side, right? Each individual property, each individual business has to be evaluated separately. You can't net them out. Wouldn't that be weird? You had two businesses. Oh, we haven't talked about business income and you netted out their like revenues and expenses. Bizarre. All right. Can you? So we kind of understand like all this stuff is property income. It's like revenue, right? That we talked about. Dividends is like property. It's revenue that you're receiving from property. It's a positive value, right? Interest, rental income. If it's just the rent that you're receiving, that's revenue. Now you can have offsetting expenses, which are going to reduce your net property income and, you know, subsequently your taxes payable, right? You're taxed on your net income. So the more expenses you got, the lower your income is, the less tax you got to pay. Oh yeah. So you can deduct anything that's an expense that is incurred to earn property income. It has to be legal. You can't start deducting like, you know, bribes, you know, or like if you're extorting people, you can't record that as income. Well, you should actually, because just so you know, this has nothing to do with property income. But if you're like earning illegal income by selling drugs, or how else can you do that? Extorting people or whatever it is you're doing. Maybe you're murder for hire. I have no idea. If you report that income, okay, the CRA can't actually report you to the police. I think if it was like human trafficking, maybe they could, but they're not linked in any way. So the CRA, because of the confidentiality involved in that, I don't think they're technically supposed to turn over that information. So anyway, that's kind of an interesting thing. That's an aside. So so you can deduct anything relative to your property income as long as it's incurred to earn that property income. So I'll give you some examples of that in a second, but you can't deduct capital assets, right? There is some CCA potentially that you could deduct on assets if they're used to earn property income, but you can't just go out and buy a building and then debit building expense, for example, right? We know how this works now. It goes through the capital cost allowance system. So it gets entered into one of these UCC pools and then you can deduct it over time. So that's what I mean by not capital in nature. You can't just deduct capital assets, but you should know that, I hope. You can't deduct personal expenses. You can't deduct personal expenses from anything, really. You guys should have figured this out having gone through employment income already, but you can't deduct personal expenses, living expenses. The expenses have to be reasonable given the circumstances, right? Which I'm not going to provide you with any expenses for property income that are unreasonable in nature. I don't think that would be mean. I'm not trying to confuse people, you know? So let's talk about interest expense now, okay? Specifically, the deduction of interest expense. We're not talking about interest income. Here's what's fun about property income is that you can have income from interest, right? I lend somebody some money. I get interest. That's income. I can also incur interest expense associated with earning property income in various forms that I can deduct from the income. What kinds of interest expense? Well, did I purchase an investment in order to earn property income? Guess what, guys? I guess you probably know this. Most things you purchase, you don't pay for in cash. Most people can't do that, right? Like, for example, if you want to buy a rental apartment, right, and you're going to rent that out, you don't rock into whoever is selling, whatever real estate agent, commercial real estate agent sells rental buildings and say, here's $40 million in cash. Now I own the building. You borrow that money from a bank, right? And so the bank charges you interest. You are paying interest. You can now deduct that mortgage interest from your property income because you are incurring that specifically to earn property income. What if you borrow money from the bank? And guys, if you ever want to find out how eager the bank is to lend you money, go into the bank and say, hey, I'd like to borrow some money so I can buy some of your mutual funds. Guess what? They'll do it. I mean, depending on your credit rating, it's going to vary by how much they lend you, but like I could rock into the bank right now and be like, hey guys, hey Bank of Montreal, which is one of the banks I bank at, I want to borrow $10,000 from you because I want to buy $10,000 of your mutual funds. And they'd be like, oh my God, sign right here. Boom, done. Here's your 10 grand. Here's your mutual funds. See you later. So how does that work? The mutual funds are going to pay me revenue, right? I'm going to get interest or whatever I get from mutual funds, whatever their form of payment is. I don't know how. I've never bought a friggin' mutual fund because they're a total ripoff, but whatever. Okay. Especially if they're sold by banks, like don't buy mutual funds, but okay. So the mutual funds are going to pay me. That's why I buy them, right? Or let's say I buy a GIC or something like that, or I borrow money to buy stock. If I go into Bank of Montreal and say, hey guys, I want to borrow money to buy your stock, I don't know how they treat that. I think they'd be annoyed, but I'd still like to do it anyway. You're still going to, like, in most economies, be up on this one. So anyway, you go and you borrow money and you buy Bank of Montreal stock. The Bank of Montreal stock pays you dividends. They always pay dividends every quarter, right? And so you have income. But because you borrowed money from the bank, you can deduct the interest that you're paying to the bank. So what you want is hopefully a rate of return that's greater than the interest rate that they're lending you money at. Does that make sense? And you've got a net positive value. Just don't dump all your money into some crappy penny stock or whatever, or do whatever you want. So for example, interest paid on money to buy shares in, like, if, oh, say this is really common, you guys, when we get into small Canadian companies, what I've been referring to up to this point is like, go buy public company shares. But let's say that, your brother owns a business or something like that, and you want to invest in it. You want to buy like 40% of the business, or you're like one of the dragons from the Dragon's Den and you want to buy 20% of some, I don't know, upstart board game company or something like that. Well, okay. So if you borrow money to buy shares in any company, small or large, right? Any related income from that, and presumably you're doing it to get dividends, is income that you earn, and then any interest that you incur is deductible, right? So shares in a pubco, rental property, we talked about mortgage already, bonds that pay interest, or any other interest earning property like a GIC, guaranteed investment certificate, something like that. But this, people are like, great. Oh, good. I can deduct my mortgage interest. Frickin' right. Nah, you can't just go buy a house, live in the house, and then deduct your mortgage interest. Although you can in America. You can't here in Canada because you're buying a house as a personal expense. Like if I borrowed $1,000 so I could buy the Death Star back there, didn't cost $1,000. It cost like $600. But if I really want a Lego Millennium Falcon or even a Star Destroyer, it's about $1,000. So if I go to the bank and I'm like, hey bank, can I borrow $1,000? They're like, sure, your interest rate's 7%. I'm like, okay. I can't deduct that interest unless I'm somehow earning property income off my Lego Death Star or whatever the hell it is I bought. I can charge kids to like play with it for $5 an hour or something like that. Anyway, you can't deduct interest on money borrowed to buy personal things. Like if you go buy a car, you can't deduct the interest on buying a car. All right. I hope that's clear. Unless you're earning property income from that car, but that's not common. All right, so rental income. Let's talk a little bit about rental income here. So compensation that is received for allowing some other party to use your tangible property. How does it work if you live in your house and rent half a year, for example? Yeah, okay. So in that case, right, that component of your house is not personal use. It is property income producing, like if you have a suite, right? So in that case, you can, I mean, you guys know that we've seen already, like for maybe home office expenses, that you would prorate a deduction based on square footage of the home. So let's say it says rent half a year. How does it work if you live in your house and rent it out? Oh, you rent it out for half a year. Oh, the entire house? Sure. Well, you'd have to report any income, right? And this is a lot of people. People like running a little Airbnb or a VRBO, or they just like on the side. I've rented places where I know it's like under the table, right? For a while, when I first moved to Victoria, I had a different home almost every semester because I wasn't sure I was going to live in Victoria. I now own a place there, but there is this guy, he lives next to Michelle Lysak. And Michelle's like, oh, this guy rents out his basement suite for super cheap. You should do it. And I was like, all right, well, sure. So that guy was not reporting the rental income. But in general, Carly, you would report any income that you received, and you have to. Like I wasn't involved. Like this guy, what he was doing was tax fraud, right? But is that my responsibility to report? I didn't know that for sure. I wasn't about to confront him on it, but my assumption was like, he's not reporting this. Anyway, you need to report all the income. And then in that case, mortgage interest for that year on whatever the square footage of the home is, or no, it would be the entire thing. So you'd have to prorate it based on days, right? So if you pay mortgage interest, someone's renting out your home for half the year, but you don't live in it for half the year. Yeah, you can deduct that mortgage interest. Sure. Yeah, sure. But where are you living? Yeah, but does that make sense? And then, sure. Ew. Guys, I've been to 70 countries. I am never, ever, ever going to Florida for any reason. I'll go anywhere. I've been to some interesting places. I would never go to Florida. But if you were to split your home, would you do it by square feet? Correct. That's correct, Tristan. So you would deduct a proportion of your mortgage interest based on the square footage of your home and based on the occupancy, right? Like if you've got a rental suite, actually, so if you got a rental suite and it's just a rental suite and it's like 40% of your home, even if it's not occupied, as long as you can prove you were like trying to rent it out and you're not using it personally, you could potentially deduct the interest there. Okay? Because it's not occupied and you're actively trying to pursue passive income. Does that make sense? By actively, I mean you're putting up an ad on Craigslist or UsedVic or wherever you guys post stuff. More questions about this? This is so much fun. Guys, I'm having such a fun time. More questions, por favor. Questions. Preguntas. Más preguntas, por favor. Is that how you say that? I don't know. We got anyone speaking Spanish here? Nothing? I will continue then. So rental property, generally earned through the rental of real estate. There's other things you can rent out. Guess what, guys? In this course, we're going to focus on real estate rental because it's the easiest to sort of manifest in your brain. So, right, you could rent other stuff out, like equipment or something like that. And generally, you include rental income on like an accrual basis, right? So it's earned when the service is complete. Now, I wouldn't worry too much about accrual as it relates to rental income. We'll talk about it as it relates to interest income. Basically, what that means is like, let's say you're renting out your warehouse, for example, and somebody pays you rent on that warehouse, but they pay you annually, okay? And so they come in the middle of the year and they're like, we want to rent your warehouse. And you're like, great, rent's due, I don't know, in 1 year, which is unusual, but okay, let's say that's how it works. So at the end of so you would have a whole calendar year that would go by, but you would have to accrue the rental income at the end of the year. And you guys are familiar with the accrual system of accounting. It's the system of accounting used in every country, everywhere, because no other system is allowed. So we've seen that for employment income, for tax purposes, we use a cash basis, but for everything else in the Income Tax Act, we use an accrual basis. So basically, if you've earned property income by the end of the year, you've earned it, but you haven't been paid it yet, right? So you can earn stuff without actually having received the money, right? For example, this rental situation that I'm talking about where somebody has used the service, they've rented your warehouse and the end of the year comes around, but they're not supposed to pay you for a while, you still have to accrue it and report income and money for the 500th time out of 6,000 times that I'll say it. Income and money are not the same thing. If you're still conflating income and money, you're in second year accounting now. You cannot continue to do that. They're very loosely related. If you've taken Accounting 111 and done a cash flow statement, you know exactly how related they are. The amount of income you have is not the same as the amount of money you have. Anyway, so the accrual system works for property income, business income, and those are the two ones that are really important here. But we're talking property. Okay, so regardless of when the money is received, you got to accrue it. So your rental income is going to equal your rental revenue minus any permitted deductions or rental expenses. Okay, so here's the costs you can deduct from rental income. A bunch of stuff. Did you incur costs to borrow money? That's called interest. Then you can deduct it. Did you pay insurance? If you're renting out your apartment and it's not insured, you're an idiot. So you did pay insurance for sure. All right, you can deduct that from your, oh guys, I have a rental apartment. It's in Victoria. All right. So I live there, but then when I'm not living there, it gets rented out, right? So I have to insure it in case somebody burns it down or whatever. So I deduct the insurance from any rental income that I have. I basically, like, during COVID times, I'm like, even. I'm not losing anything. And they're paying down my mortgage, which is great. But property taxes, sure, you can deduct that. Repairs. Oh man, did like a tree fall through my window? Oh, that sucks. I had some like work I had to do, some repair work. A couple of years ago, there's like a flood. I had to pay for stuff. Insurance didn't cover it. So yeah, you deduct that. Maintenance costs. Yeah, sure. Cost to maintain stuff. What other things that you would have on a rental property, like strata fees, management fees, junk like that, cost of utilities? Are you advertising for this? I don't know. Maybe you've got some big rental building. You're advertising, hey, come live in my rental building. Sure. Anything that makes sense, guys. Did that property income that you earn, did the expense that you incurred, was it for earning property income? If it was, okay, unless it's illegal. Okay. You can't deduct illegal expenses, but you must report illegal revenue. I don't write the Tax Act, but it makes sense. Ooh, landscaping costs. Sure. You planting some trees. You got like a gardener coming in to like make the place look nice. CCA. Sure. CCA. Okay. So there, look, if you have a building and you own a building, you can deduct capital cost allowance on it. Now we're going to talk a little bit about how stupid that is, but you can do it if you want. Remember that CCA is a permissive deduction and you don't have to take it. But look, if you buy some appliances, if you buy like a television, like my apartment has a television, people use the television. I don't know. I got Netflix. I can deduct my Netflix cost, whatever. CCA, yeah, I mean, I got like linens. Bought a toaster. I mean, what do you want? You can potentially take CCA on junk like that, right? Whatever other appliances. Anything that makes sense. Salaries and wages. I mean, I don't have anybody running my rental apartment, but if I had an entire, let's say I had an apartment that had like 4 suites in it, I'm hiring somebody to manage it. They go by once a week and they, I don't know, make sure people aren't, running a meth lab or whatever. Great. So any salaries that I pay in respect of earning property income, property management, I talked about that. Here's where you can deduct accounting costs. Employees, hey, employees, you can't deduct accounting costs. But, if you're earning property income, okay, because somebody's probably doing your tax return for you. I doubt you're doing it on your own. I hope so. Everybody in here should be able to after this course. It's very not hard. The T1 project that I give you, which is a legitimate project, these like T4, T5 projects, it's like half an hour of data entry, but the T1 project will have property income. So you guys can get a chance to practice filling out a tax return for a guy who has all sorts of interesting things going on in his life. All right. And then you can fill out all the fun forms. The T1 project's fun. You just complete a tax return. Do you want to come out of this course without any skills? I don't think so. You want to have a skill. So if you can complete like a semi-hard T1, boom, immediately you're more marketable as a human. Costs incurred to collect rents. Ooh, this could mean what? If I have to collect rents, then I might have to pay like a lawyer to get involved, or I might have hired muscle. Do you know what that is? If you like hired goons, you get to come by and intimidate your renters. I got friends who got rental properties who have real issues with the renters, right? They don't generally hire goons, but you may have to hire some form of, let's say, professional services to get the rent. And usually that's, I don't know, I would say, you get legal people involved. It's a real pain in the ass renters sometimes, right? I've had a number over the years. So the CCA for rental properties, this is kind of a little bit interesting. We're not going to delve too deeply into it. I think there are a couple questions, and I do a whole video on it. It's like a boring video. We might not get into that today. These lectures take a long time. Remember that normally this would take 4 hours of lecture time, and I'm just kind of talking to you in an hour and a half to like get the overview of it so you can delve more deeply into it and then ask me questions about it. But we know this by now. There's no way I'm supposed to be squishing 4 hours into 2 hours or an hour and a half. So here we have CCA rental property. So each rental property, this is so fun. Remember class 10.1, do you? Do you remember class 10.1? Where each 10.1 passenger vehicle or luxury vehicle got put into its own class 10.1. So there could be multiple 10.1s, whereas you'd only ever have one class 8 pool, right? Everything. Oh, no, that's not true. You'll find out in 375. You can maybe have a couple more, but for you guys, there's only one class 10, for example. Okay, that's a good one. There's only one class 50, for example. Here, when you have a rental property that costs greater than $50,000, hey guys, what percentage of rental properties currently available on the market costs more than $50,000? 100%. There you go, Carly. Yeah, but if you go back to when this was written, I guarantee you this provision was written in the 70s, right? Possibly the 80s, where that kind of thing was realistic. But the Income Tax Act, it doesn't really matter, right? The whole point of it is like every rental property goes into its own separate class, which you would want to do because you could take advantage of terminal losses, which everyone is familiar with. So they get put into separate class ones. So you could have, if you've got multiple rental properties, you've got multiple class ones. What's the rate on class one? Did you remember this? Do you memorize this? Do you rememberize these things? Boo. Nice, Carson. Don't put a question mark on that. Put an exclamation point. Don't ever be like, I don't know. Just like, boom, I know what I'm talking about. Like Donald Trump. That's how he's so successful. He doesn't ask questions. He just makes statements. So stupid. All right. Don't be like that guy. All right. It's a good question. So rental losses can't be increased or created by deducting capital cost allowance. So you can certainly deduct capital cost allowance from your rental property, provided that you have depreciable assets that are earning you income, but you cannot deduct an amount that makes a loss. So if you have a slight positive value of rental income prior to CCA, you can deduct CCA up to the point where you reduce your net rental income to zero, but you cannot then create a loss by deducting CCA. Additionally, if you already, prior to deducting CCA, have a rental loss for the year, which is very possible. Many people have rental losses, especially this year, right? Yeah, I had my whole summer lined up with my little Airbnb deal. And then COVID hits, and then everybody cancels one by one by one by one by one. What are you going to do, right? So you can't increase a loss by deducting CCA. Let me ask you something, guys. Do you think I deduct CCA on my rental apartment? Or should you deduct CCA on your rental apartment? I don't know if I made a slide for this, so I want to talk about it. The answer is definitely not. You probably should. Okay, Tristan, I like that you came up with a statement on this and it was definitive, and probably you're right. Why do we deduct CCA? Because it's an expense and we want our net income for tax purposes to be smaller. However, in the instance of rental properties, is worth the amount of time. All right, so here's the deal though. Most depreciable property depreciates. Agreed? That's the whole point of why we depreciate it, because we have to, or because we can. Buildings sometimes are worth more when you sell them than they were when you bought them. Can you see the problem this creates? If you buy a building for $400,000, a rental property, who cares what it is? I buy a rental property for $400,000. And then for a couple of years, I'm earning rental income. And then in 2 years, I sell it for $600,000. Now, keep in mind, I've been taking CCA for those years. So every year I'm taking my 4%, $16,000 or whatever it is. Seems like a sweet deduction. What's going to happen when I sell my building for $600,000? I can wait. Oh, I'm just going to wait. What's going to happen? You will have a capital gain, which you're not going to be able to avoid. That's not the problem here. You're not incorrect, my friend, by the way, Tristan. This is testing your knowledge of the capital costs allowance system and how it works. In addition to capital gains, for which there is an immediate tax consequence, what else will happen to you? How many people do I have here? I don't even know. Somebody throw it out there. Nobody? Legit? Nobody's got this? It will outweigh the deductions from smaller items. Not exactly. Good try. I appreciate the effort very much. So here's the deal, guys. What happens if you've got UCC of 300 grand and then you go and sell a thing? It's the only thing in the pool and you sell it for 600 grand. It cost 400. What comes out of the pool? The lower of cost or proceeds. If the lower of cost or proceeds is like 400,000 or 600,000, what happens? you are going to create a negative balance in your UCC pool. What happens if there's a negative balance in your UCC pool? See, if this was a real class, I'd just be standing up in front of the whole class, holding my little laser pointer, waiting for somebody to say something. And then like the two people, kinda getting warmer. No, Carly, good try. Have you guys watched these? Yeah, there will be text on what? Yes! Ding, 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 ding. I want to have like a little bell here. I can get ding. Great job, Katie. Katie, yeah, there's going to be recapture. Is recapture good or bad? Type in with an emoji if you think it's good or bad. Give me a happy face, a sad face, or a meh face. Do you have access to those emoji? Yeah, there we go. There's no emoji? Zoom, this is bullshit. Give me some sweet emoji. Give me a poop. Okay, so it's bad. Recapture is bad because it's an income inclusion. So in general, you're going to sell your rental property for more than you paid for it. If you have been taking CCA, that will generate recapture, and everything that you deducted for CCA is now going to come back right in your face, and you're going to have to pay tax on it. So if you've been doing it for 5 years and you've deducted like 60 grand worth of CCA, guess what? You now have 60 grand worth of income that you're going to have to pay tax on. And this isn't taxed at 50%, guys, right? It's not a 50% inclusion. It's going to be taxed at whatever friggin' marginal rate you've got. So if you're the owner of multiple rental properties, you're usually in a higher tax bracket. Thereby, this is bad. So after all of that, I hope I've explained, don't take CCA on the building. Anything that you think you're going to sell for more than you paid for it, don't take CCA. Unless you're going to die soon, in which case, do it, because someone else can deal with that. What happens when you die for tax purposes, guys? Is that it? You don't have to do taxes anymore? Yeah, well, still pay. It depends. Maybe you'll get a refund, right? But you're responsible for remitting taxes. So somebody, your estate, your family has to pay lots of taxes. Not necessarily lots, all right? It's your estate, Tristan, that's right. Okay, so somebody, like somebody submits, and I've done this before where I've prepared tax returns for people who have died. It's kind of sad, right? It's never really rich people that I've done tax returns for, but like people who are, middle class or whatever. Sometimes it's people living by themselves, and what you get is like a shoebox full of all of their like final, like, I don't know, T4s, T5, and they usually don't have T4s, but T4As and pension receipts and like medical expenses and stuff like that. Then you got to cobble together this tax return for a dead person. And then their estate is going to have some tax bill, which ultimately somebody in the immediate family is going to have to pay. Unless they don't have somebody in the immediate family. But usually you've got enough assets that once those get sold off, like the estate will sell them off. You've got some person who's the executor of your will, and they'll sell off all your shit and then pay off your taxes. But if not, then I think the province deals with it. Anyway, tidy up your stuff before you die, guys. Always have this stuff worked out so it doesn't create this horrible burden for your family. Is this macabre? What's the saying, guys? There's a saying, and I can't remember where it's from. I really want to know where it's from, but there's only 2 guarantees in life, right? There's 2 things that when you're born, you're guaranteed are going to happen to you: death and also taxes. Carly, that's awesome. I got to have one of those too. But like, I don't know if I'd keep it on my desktop just yet, but I might keep it like, I don't know, on my fridge or something, open when I'm dead. But then when people came over, I have a lot of dinner guests. And my dinner guests are going to be like, what do you have planned for tonight? Okay, let's keep going. So there's a sample problem for you guys there, okay? Then we got royalty income. Look, there's like this is in my infancy when I was creating these. Apparently Ben Franklin, yeah, that makes sense. Yeah, I don't like to Google stuff while I'm talking to you guys, but thank you, Tristan. Yeah, Ben Franklin, Ben Franklin said a lot of stuff. All right, so payment received from the use or exploitation of artistic or literary works, patents or mineral rights or something like that. So many, many years ago, like Paul McCartney, do you know who that is? He's one of the Beatles. And then Michael Jackson, do you remember who that is? He was like a famous singer. He's part of the Jackson 5. Michael Jackson died, but back in the 80s, Paul McCartney and Michael Jackson were good friends. They even recorded 2 songs together. And then Michael Jackson went behind his back and bought all the rights to the Beatles songs. So like all the royalties from the Beatles songs went to Michael Jackson's estate. You can look this stuff up. It's brutal. Well, smart. I don't know if he went behind his back or what the deal was, but like they were available for sale and he purchased them. So all these Beatles were now, I think the estate of McCartney and Harrison and all these guys, they get, I'm not sure exactly how it worked, but there was some deal where Michael Jackson got a bunch of royalties from the Beatles songs. You can Google that one too, Tristan. Also Google the songs that Michael Jackson and Paul McCartney sang together. They're not bad. They're okay. So normally you would treat royalties, it's just royalty income, right? So if somebody pays I write some songs and somebody plays them on the radio, then I get some money. If I write a book, and then, you know, usually when you write a book, you get some big upfront, what's it called? And it's not called a retainer, that's for lawyers, but you get this upfront fee for writing a book. I can't remember off the top of my head. I've never written one. And then as the books are sold, you earn royalties, right? That's passively earned, right? Yeah, you put in a bunch of work, but you retain the rights to that, and then you'll earn royalties over time. That's property income, guys. Trademark, copyrights, patents, etc. So yeah, it's possible that that could be considered business income as well, depending on how actively you're pursuing that. Like potentially if you're a singer-songwriter and that's your business, right? Then this could potentially be considered business income. But if you just own the rights to something, like Michael Jackson did, then that's passive property income. But you know what? I don't know how the American tax system works. It's just an example. So musicians who write songs, authors, etc. Okay, blah, 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 blah. I don't know why I even have these slides anymore at the end, but basically it's just like you need to do a bunch of course pack problems. I think there's 6 of them for property income. And then there's the videos and stuff, so you can watch those. This stuff's not super, 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 super hard. Okay. I should do a little bit on interest and dividends, but I'm going to have to go pretty quick. I'd like to do some problems, but if I don't have time to do the problems, don't forget that Kathy's done all the problems. So you can go and watch her videos. What do you guys prefer? Do you want me to do some more lecture stuff so I explain concepts? Or I can just jump right into the problems, but I haven't really explained a bunch of the other stuff yet. Well, that's like a funny look I've got going on there. Any takes? Any, oops, someone's in the waiting room. I didn't notice. No one has any opinions, it sounds like. So, in the lack of opinions, in the absence of opinions on things, I'll just go ahead and maybe I'll talk about interest or dividends. Lecture, I guess. We can watch the solutions if we need to. Yeah, sure. You can also watch my lectures if you need to, but I'll do it. I mean, we have a limited amount of time together, so I find that people are maybe are enjoying this. I don't know. I don't get a lot of feedback. Look, I've set up all the problems to do. Let's do dividends. It's super quick, and I added a couple things to it. I need to reanimate this, but slideshow. Oh, my back is killing me. 30 seconds. I got to find like a pillow or something for this chair. I've been sitting in this chair for so long. My class is oh, what does that even mean? This isn't even a class. This is just some dingbat, me talking to a computer. Ugh, I wish it was a class. Okay, have a second. Okay, pillow. Oh, well, dude, I have this chair to eat dinner with. I don't do a lot of work at home, but now that I'm doing like all this cool video production and I got my awesome YouTube channel, like I'm going to have to get a better chair, obviously. I'm also going to get my stand-up desk from Camosun. I think I'm going to head to the island sometime early next week and like ransack my office and get all the cool shit, like all the Lego, stand-up desk, whatever else I need. Maybe I'll take the computer, who knows? But yeah, you're right, Tristan. Okay, let's continue on there. We're going to talk about dividends. Here we go. What? Okay. I got the same clip art for everything. It's boring. So dividends is just a return on investment provided when you purchase shares in a corporation. So I've mentioned some of the shares that I own, some of the best stocks. Not all shares of stock pay dividends, right? So usually with a small private corporation, you'll definitely be getting some dividends if you own shares. And generally when you own shares in a privately held company, it's usually somebody you know or your family member or something like that, or you own it yourself. If you're like own your own corporation, you own 100% of the shares. How do you think you get money from that corporation? Well, if it's a corporation, you can take a salary or you can get paid dividends direct out of retained earnings. And in 375, we do an analysis on what's better. And it really depends, okay? But generally, that's how people get money out of their corps, is that they take dividends. They can also set up various, if you have co-owners, like, generally, you'll have a few owners, family members or friends or whatever, who own like your brewery, for example. Hey, are there any breweries in Victoria? There's 1,000, I know. I don't really drink much beer anymore because when you hit a certain age, like you just turn into a big person if you continue to drink beer. But I did have a good run, and boy, within a 1 kilometer radius of my apartment, I think there were 6 breweries at one point. They all make money because people love getting drunk. They just love it. None of these things go out of business, right? Oh my God, dude, like there is a brewery opening up across the street from my apartment. There's already one that I can see from my window. It's the Canoe Club. It's right across the street. And then just like half a block up, there's some other brewery that's opening up. Also, Swans is right across the street. Also, Driftwood's down the street. Also, Hoyne. Also, Granville Island Brewing. Also, Phillips. Also, Il Sauvage. I mean, it just goes on and on and on. It's crazy, right? But people like drinking, and there doesn't seem to be any saturation point. So for example, these breweries, so I used to hang out at Il Sauvage, which makes sour beers, and they had this sort of offering early on where you could buy shares. They're like, look, we're looking to incorporate, and we want to get some seed money. So people who were just like in the neighborhood or who knew them, like they posted on Instagram, do you want to buy some of our shares? So you could have gone in and bought 2%, 3%, whatever it is of the business, right? Now, are you getting dividends out of that? I don't know. But part of the deal was that you would get like, I don't know, like a weekly growler fill or something like that, which is pretty dope, right? I wish I had known about that. So keep your eyes peeled for like cool investment opportunities like that, because like you say, they never go out of business. But anyway, that's how you own a company, right? And so you invest in shares of a corporation, you'll receive dividends. And a good example is I own shares in CIBC. This is a great stock, right? It generally tends to go up in value and the dividend yield is quite high. So I will receive dividends passively through the ownership of that corporation. I also own shares in Tesla. They never have paid dividends, and I doubt they ever will because they don't need to. Their shares are so highly valued, probably way overvalued, but who cares, all right? So dividend income can be received both by individuals and corporations. Our focus is on individuals in this course. The tax treatment is going to be different for dividends depending on the type of recipient, meaning is it an individual or a corporation? It's individual for us. And the type of dividend received, there's going to be a couple types of dividends that can be received. Now, the explanation behind why there are 2 types of dividend won't become clear until you get into accounting 375. And it doesn't matter, okay? You just need to know how to treat them for tax purposes. And if you want to do more, I mean, look, it's all in the textbook or there's some of it. There's a bit of a discussion of it in the course pack, all right? But it's something that if you want to know more about it, you can do your own independent research because it's just like confusing early on. So dividends issued by taxable Canadian corps, okay, are grossed up, meaning the value is increased. So if I receive $1,000 of actual dividend money, what goes into my tax return and the income I report will be higher than that. It will be grossed up and it will be included in income in the year that I receive it. So the amount by which the dividend is going to be grossed up varies, which is annoying, but it's true. Okay, there's only 2 kinds, so we don't have to stress out too much. There's very little you have to memorize here, right? Now, if you have received a dividend from a private corporation, i.e. the brewery down the street, guess what, guys? The brewery down the street is not a publicly traded company. It's still a corporation, but it's privately owned. Guess what else is privately owned? Lego, privately owned corporation, all right? I can't buy shares in that. It's only the Lego family, and that's not their name, but they're a Danish family, and you can't, it's not publicly traded, although it probably should be. Okay, so a private corporation, if you receive dividends from them, here's what's important. You have to gross up that value that you receive. I'm going to point to the correct one here, which is 2019 and beyond. And guys, we're in beyond right now. You gross them up by 115%. The gross up itself is 15%. So look, if I got $1,000 dividend, the amount that I include in my income, and this is from like local private company, okay, the amount that I include is 1,150, right? The amount of the gross up is 150 bucks. That's the 15%. But if I want to show in total how much I'm including in my income, it's you times it by 115%. And that's how percentages work. Okay. So you can see that here for 2018, it was different. Guess what? For 2017, it was different too. And for 2016, it was different too. You probably don't need to know this. Okay. But I covered my ass in this video by making sure that I kind of included that these rates can change, and these rates do potentially change. But for the foreseeable future, if you receive a dividend from a private corporation, this is called a non-eligible dividend. Why? It doesn't matter for right now. Okay, that's just what it's called. Sometimes you'll see it as other than eligible, which is stupid. But that's what it's called sometimes. You gross up by 115%, right? Or you add 15%. If you receive a dividend from a publicly traded company, i.e. CIBC, the Bank of Montreal, oh, Apple pays dividends, although they don't pay that much. I think Microsoft does. Google doesn't. Screw you, Google. Netflix doesn't, right? But the value of their shares, people buy those shares speculatively because the share value goes up and then they sell it. And then you got capital gains, right? So if you receive a dividend from a public corporation, it's referred to as an eligible dividend. You gross that up by 138%. That hasn't changed in like my lifetime. And I want, okay, not my lifetime, but my lifetime as an accounting personnel, if that's what I am. Ooh. I don't like the idea. I don't really describe myself as an accountant anymore. Anyway, so dividend tax credit. So what happens is, that seems weird. You should immediately being like, what the shit? Why the hell? If I get $1,000, do I have to include 1,380 bucks of income? It doesn't make a lot of sense, right? So the reason here is that it has to do with how dividends flow out of corporations, and the fact that, hey guys, did you know that corporations get taxed? They do. So the money that gets paid out of a corporation to an individual human with a dividend, that's after tax income. So already that money's been taxed, and then when you get it, it gets taxed again, right? Kind of a raw deal. It kind of is. But what happens is that you'll get this dividend tax credit, and the dividend tax credit for an individual will basically offset the amount of tax that was paid in the corporation. I know, and we haven't talked about tax credits yet. So this is going to be really confusing for people, and I understand, which is why I don't ask questions about dividend tax credits on my exams. You can take that one to the bank, guys. I'm not going to ask you about dividend tax credits on your midterm. Maybe on your final, because we talk about tax credits in like week 10 and week 11 and stuff like that. But for now, like I said, it's really hard to teach tax in a linear fashion because all of these things kind of tie together. All you need to know right now is that if you receive a non-eligible dividend, you have to gross that up by 115%. If you receive an eligible dividend, you have to gross that up by 138%, and then it gets included in income. Do not worry about the tax credit stuff, okay? I just want you to know, because I don't want you to think that I don't know, because I know, right? So, hey, here's an example. This is fun. Joe taxpayer receives a $725 eligible cash dividend from a publicly traded company during the taxation year. Let's see what I have in store here. How much does the taxpayer include in their income from property for the taxation year? Well, they're going to take 725 bucks. They're going to multiply it by 1.38. Is that $1,000? Wow. It's like I reverse engineered this question. So that's how much income is going to be included in the taxpayer's tax return for the year, and they have to pay tax on $1,000. How much money does Joe taxpayer have? Joe taxpayer has $725. This is income. I can't write with a mouse, guys. It's so hard. I don't have a big touch screen. Hey, Kamosin, buy me a giant touch screen. Then I could just like, whoosh, be great, but I can't do that. So that's income, and this is money. Can you see that these things, this is not an equation. This is an equation down here. But 725 does not equal $1,000, okay? So I get 725 bucks worth of money, I record 1,000 bucks worth of income. So the individual taxpayer, and that's stated right here, even though they only got 725 in cash. Later on, you get a tax credit and it all works itself out, but don't worry about that, just the treatment, okay? Here's an example of a non-eligible dividend. So here's a taxpayer, they receive an 860, I should have done a different number, but whatever, you guys can work this out for yourself. An $862 non-eligible cash dividend from a privately held Canadian co. Note it's 2019 here. Okay, so the rate that we're going to use is 115. And that's the rate you'll use for everything that you guys do. Like literally, I'm not going to ask you to do a tax return from 2018. Who the hell do you think I am? I'm not a mean guy, okay? Well, it depends on the scenario. Okay, so how much should the taxpayer include in their income from property for the taxation year? Well, we're going to take the 862, we're going to multiply it by 1.15. Boom! This is income. And that's what you have to report in your tax return. Okay, okay. So 991 in property income, even though they received 862 in cash. Look, we can go through this one real quick, but check this out. It's 2018. You get the same amount of not, Christ. You get the same, do we typically round to a whole number? Sure. I don't know, Katie, like, okay. Do you guys want me to go through the rounding speech? Look, if you do, okay. When was the last time you guys cared about an amount of money that was less than $1? Do they matter to you, Tristan? Okay, Carly, in finance class? In finance class, are you rounding your answers? Or are you just being like, oh, the answer is $12.14? Here's how it works. And people don't get this. When you're doing calculations, right? If you're using numbers to do individual calculations and do calculation work, you can't really round, right? Because especially like if you're buying, when you get into like calculating stock option benefits or something like that, I don't know, maybe, you know, you're calculating 14 cents per share and you've got 20,000 shares. So you multiply that out. It doesn't make sense to round 14 cents to 0. But when you give a final answer to me on an exam, I don't care if you're off by 10 cents. I don't care if you're off by 90 cents. I literally don't care if you're off by $90. It is an immaterial, useless, like negligible, noisy amount of money. All right. When you're filling out a T5 for someone, technically you're supposed to include the pennies. There is, I mean, here's the thing with T5s nowadays, is that a T5 is it's like a T4 that you get from your work, but a T5 you get from a financial institution, and they're going to say how much interest that you earned, or they're going to say how much dividends you earned, right? You're going to eligible, non-eligible, whatever. And because you receive it from the financial institution, right, it'll have pennies on it. And so that automatically gets sent to the CRA, and now your tax return is automatically populated. If you as a tax preparer receive a T5 and you're preparing somebody's tax return, and you get one of these forms and it has pennies on it, you include the pennies. In my class, why? Tristan literally says, God, no, about pennies. And it's true. Like even on your tax return, they don't care. They say like, if you're off by $2, it's fine. The CRA doesn't care. Technically, you're supposed to report the exact right amount, but like they're not going to chase you down if you're out by $5. Does anyone think the CRA has like police, like enforcement agents that are going to come to your house and be like, hey man, you're out by 43 cents. So tax fraud. It's like, you got to be out by $40,000 for them to notice, right? Depends on what it is, right? Depends on the expense. I mean, they call my cell phone every day saying I'm being sued. I love those guys. Oh, dude, I try every single time, literally how many other people have been receiving phone calls from the, it says Service Canada. That's what they say. They say Service Canada. That's not a thing, guys, right? I know it's so funny. Well, you know, that's bad if your social insurance number is compromised every other day. But like these dudes call. It's always dudes. I never get ladies calling. And like, I'm like, oh my God, it says press 1 now. So I'm like, I got to press it. And then I try to see how far I can get with them, like every single time, because I find it so amusing. And so I'll go on for a while. They'll be like, what's your name? And I'll make up some name because I don't want to give them my real name. And then I'll ask them like the lowest level, like lowball questions and be like, so what's your name? And usually they won't tell me, but sometimes it'll be someone with a very thick accent from some country. And they'll be like, oh, my name's Jeff Smith. I'm like, really? Is it? Okay, cool. Okay, Jeff. So let's keep going. And then I'll be like, what seems to be the problem? They're like, oh, you owe us a lot of money. I'm like, okay, great. So, and then you ask like, really, so what's this in respect of? And if you ask even a semi-intelligent question, they'll hang up on you. Like semi-intelligent. My friend gave her 2-year-old the phone when they call. Yeah, they just hang up. And so some days I can get them to go for like 30 seconds or a minute, but I don't know who they're fleecing. I think they're listening to see if it's the elderly, because usually they're the ones who are drawn in by this, and people prey on them because they're not normally tech savvy, and they're older people are full of fear. It seems like a lot of the times. Yeah, you get towards the end of your life, you're like, I'm scared of a lot of things, and you don't understand. You can't keep up with technology. Anyway, guys, this is a bit of a sidetrack, but it is related to tax. If somebody calls you and they say you're going to be arrested, you're not. That's not how the police work. The police don't call you and say you're going to be arrested. The CRA doesn't call you and say you're going to get arrested. So anyway, I don't know how we got on this tangent here. So how much, this is 2018, how much did the taxpayer receive? So we got dividend from a corporation. Because it's 2018, there was a different rate. It was 16 cents. So look, it would have been $1,000. Can you see how they've changed somewhat? And you would report different levels of income. The dividend tax credit changed as well. So it basically just netted out. And the reasons that they do this will become clear in subsequent courses, but I don't want to spend any more time on it because it's already 142. Okay, so same thing, $1,000 in property income, even though you got $862 of cash. Does anyone have any questions related to dividends so far? I'm sorry for getting waylaid there, but boy, oh boy, those guys, they're so funny. Just don't ever give them real information, okay? They don't have anything on you. They're located in some country very far away. They're never in Canada. Okay, so dividends from foreign corps. This is new. You don't have this in your slides, guys. I made this today. Should we worry about prorating and being off by a day? No. Flat out no. Who cares? Katie, I love your questions. Your questions are typical of a very great majority of accounting students. And I'm here to tell you, I'm going to give you practical advice. These finance guys, I don't know what their deal is. I have no idea. But okay. Yeah, detail-oriented to an extent. But what are we talking about here? $6? What difference is that going to make, right? That's what I'm getting at. In all practicality, you just need to get in the right region or area. Guys, if your tax return, if somebody prepared your tax return and they were off by $6, would you really care? Really? 6? So the idea behind prorating and being off by a day, no, I don't care at all. I'm just like, this kind of stuff. This is why this is another, no. I appreciate it, Katie. Katie, it's a great question and I appreciate it. I spend so much time talking to people about rounding. If you guys go and become CPAs and you work in an accounting firm, right? Materiality, what we call materiality, depending on the job, is going to be like 60,000, 90,000. I've worked on jobs where materiality is like $400,000, meaning if you find an error and it's less than $400,000, you don't even report it. It doesn't mean anything, right? Imagine working for because it doesn't. You go work for Tesla or you go work for, who cares? Just insert CIBC or whatever here. If I'm doing the audit of them and they're out by $20,000, their financial statements are reported in hundreds of millions, if not billions of dollars. It doesn't make a goddamn difference. So you guys can do the same thing, sort of math in your head. If someone's tax return is for $100,000 and you're off by $7, it's meaningless. I have a question. Do you claim RSP stuff for the first 60 days of the year? Does this apply to dividends or? Oh, I kind of see what you're saying. RSPs aren't related at all to this. We'll talk about RSPs in the 60-day grace period that you get on that. That's one of the fun things where, I mean, you don't submit your tax return until April 30th of the following year, right? So what happens is that the government gives you 2 months to kind of figure out what your income's going to be, and then they allow you to take that RSP deduction. Dividends? No, if I receive dividends, right, in the year 2020, that's on my 2020 tax return. Unless I've accrued some amount prior to that. So not exactly. Carly. Okay, not necessarily. Not necessarily. We just basically use the accrual system of accounting. So if you've earned dividends in a prior year, you'd have to report them in the prior year. If you earn them in the current year, you report them in the current year. It's accrual system. That won't really factor into dividends, right? It kind of does if dividends are declared and not paid, but dividends generally are paid at specific times, and you'll get T5'd for that stuff by your financial institution. It more has to do with like interest, and there's accrual stuff for interest, but it's not exactly the same. I can't wait to talk about RSP stuff. Which my bank account was off by 400K. Up or down, Tristan? Okay, so taxes are withheld, but so foreign dividends, guys, I need to talk about these real quick because they do come up in some of the problems. And I punched this stuff in here. I'm not going to re-record this in the next day or two, but I'll put the slides up so you'll have these slides, but you have this, it's recorded. Yeah, I mean, I guess so. They're not going to give you a reward though. They're not going to be like, oh, we're really sorry about the 400K. Here's $1,000. Okay, so foreign corps. This is if I own shares in a foreign corporation, right? I own several shares in several foreign corporations. Let's say, no, Netflix isn't a good example. I own shares of American Express, okay? Or Berkshire Hathaway. Not Berkshire A, but Berkshire B. But they're going to issue dividends to me on an annual basis, right? Or quarterly basis generally is how dividends are issued by these big corporations, generally quarterly, right? Some annually, some quarterly. Foreign corporation issues me a dividend. What happens is because the company is in America, that issuing corporation is going to withhold taxes because guess what? That money was earned in a foreign jurisdiction. Who wants that money? Let's say it's America. The IRS wants the tax money on that income that you earned by owning American property, right? So what'll happen is you'll be issued a dividend, but that will be net of withholding taxes, right? So taxpayer will receive actual cash net of the foreign taxes. Now, technically you will get these paid in like a foreign currency, but I'm going to ignore that because we don't want to deal with translation stuff, okay? So if you receive a dividend from a foreign corporation, which is not uncommon, you will not gross that dividend up, okay? It's only from Canadian corporations that you gross up dividends. The foreign dividends are included at their gross amount, right? Prior to the foreign tax having been deducted. So you're going to receive, if this is the entire amount of the dividend, you're only going to receive that much. You report this much in income, okay? That's how that works. So depending on the country, okay, where you receive the dividends from, and usually what we're talking, I mean, it's hard to invest in publicly traded stocks in many countries. Go try and purchase publicly traded shares from the Venezuelan stock exchange. You're going to have a bad time, right? But if you, I mean, it's very common to own American corporations. So American shares in American corporations. So what happens is the USA and Canada have a reciprocal tax treaty, right? Whereby you can't be double taxed on income that you've earned. So you will report the entire amount. And you can see how this creates a problem, right? You've already had taxes withheld in America, but then you include the entire amount of the dividend. That will generate tax on the entire amount of dividend in Canada, which like, sucks. That's double taxation. But what happens is you will, as long as there's a tax treaty with that country, you receive a tax credit. It's called a foreign tax credit, and that will reduce your amount of taxes payable down to the level that it should be. So you won't pay tax twice. It effectively treats it like you've already paid the tax. So you only have to pay tax once, okay? So it prevents double taxation. Is this confusing? Meh. One question of the tax treaty between Canada. Yeah, sure. Oh yeah, there's tax treaties between Canada and the majority of like, I never know what to say. Developed nations. I don't think we use the term first world, third world, that kind of stuff anymore. It's like insulting to people who live in countries that would be classified as third world. You only ever hear first world and third world. Do you guys know what second world countries are? What the technical classification of that is? When they came up with these stupid generalities. Second world countries were communist countries, right? Like Russia would have been a second world country, or like Cuba or Vietnam or whatever. So anyway, yeah, there's tax treaties between Canada and most developed nations, right? For sure. So Japan, 100%. Korea, 100%. And then I'm not going to say any more in case I offend somebody, which I invariably will do. The majority of countries have, like Burma, you wouldn't have like a Burmese Canadian tax agreement because their economy is like entirely black market underground. Cool. So yeah, let's see. So here's an example of foreign corp div. All right. There's me. I own shares in USA Corp. Yay. I get dividends of $8,000, and I'm putting this in Canadian dollars. I technically would have translated it from US dollars, but who cares? Okay. So it says ignore. Net of 2,000. If I receive 8,000 dividends, 8,000 in dividends, net of $2,000 of tax, what was the original amount of the dividend? What is the gross amount of the dividend? Thanks, Heather. You're correct. Okay, good. A lot of people at this stage in their careers don't seem to have worked out the difference between gross and net. That's something you want to get a handle on. So if something is net of tax, that means the tax has been taken off. So if $2,000 was taken off and you have $8,000 left, that means the gross amount was 10 grand. So what happens is, how does this foreign dividend affect Ryan's net income for tax purposes? Ryan includes $10,000 in his income. All right. That's property income in my tax return. I will ultimately get a foreign tax credit. It won't be exactly 2,000. It'll be close to 2,000. We'll never calculate foreign tax credits in here. We don't even do it in 375. It's too hard. That's going to reduce taxes payable. All right. It's beyond the scope of this course, but I'm sure you'll agree that it's very interesting. All right. Dividends received by corporations. Ugh. You don't really need to know this, but look, there's an American $100 bill, y'all. Real quick, just for fun, because I'm here. Oops. Oh, God, GD. God, mother. Okay. So if you're a corporation and you receive dividends, can corporations own shares in other corporations? Duh, sure. The corporations can buy whatever they want, right? So if they've got extra cash and they want to buy dividends in some other corp, that's very, very, very common, especially for like small corporations. So like when you guys go start doing tax returns for people, and if you work in small firms, you're going to see all these weird convoluted setups between family members and all their like related and non-related corporations where dividends flow from one corporation to another. So basically, if a corporation receives a dividend, then that just gets included in net income for tax purposes. All right. They're not grossed up at all. If dividends are received from a private Canadian corporation, they would be deducted as a Division C deduction, which we haven't really talked about yet. So don't stress out about it. Okay. All you probably need, actually, you don't need to know any of this right now. It's just for future reference, okay? Basically, it goes in and it goes out. So you're not going to be taxed on these effectively if they're dividends from a private corporation. It just reduces the risk of multiple taxation, but don't stress out about that, guys. Ooh, that's all for this. That's from Looney Tunes, guys. It's cartoons from the 1930s. Okay, so I'm going to get out of this one. There's like a really brief interest thing I want to talk about. People get so bent out at people. Here's one thing I don't get is like why people struggle with calculating interest so much. There's a principal amount. What happened to my lighting? My face, like all of a sudden, it looks like I've got COVID. How about this? I love this one. Okay. So for some reason, students have a real problem calculating interest. In this class, you never need a financial calculator, okay, for tax purposes. All you're doing is adding numbers and subtracting them, and sometimes you'll multiply a thing. So we have the very, 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 very simple interest calculations in this course. You just take the principal amount, and then you multiply it by a rate, and then you prorate that for the amount of time you had money borrowed in the year. So I hope that people get that. I'm not trying to like condescend to anybody, but it's something that I see so frequently where people screw up interest calculations. So hopefully you guys are going to be the group that just nails interest. So I'm going to talk real quick about interest stuff, and then we're going to, if I got any time, we'll do a problem or two, like real quick. And then, I don't know, you guys can ask me some questions. Oh no. I didn't turn off the play narrations. Okay. Nerd alert. That's this guy. Okay. So definition of interest income. So interest is just defined as the compensation received for the use of borrowed funds. So By borrowing, I mean the bank is effectively borrowing my funds, right? Or if I buy a bond, let's say some company issues a bond, it's because I lent them money. It's because they're borrowing money from me. If I buy a bond from the government of Canada, which you can do, go down to the bank, buy government bonds. Sweet. Very safe. You'll get a very minimum amount of income. But if the market fluctuates like it has been, like tremendously in the past 8 months or so, bonds are generally insulated from that. You're generally guaranteed a return on your bonds, all right? Especially in a country like Canada or the United States. Interest rates can fluctuate, so it's not guaranteed, but it's a lot safer if you're looking for a safe bet. So if I go and buy bonds from the government of Canada, right, I'm lending them my money. The government of Canada is using that money for stuff, whatever they're using it for. They're building a road, they're paying the military salaries, they're paying out the federal CERB. I don't know how to say it. I don't get any. But that's your money's being used, right? They're borrowing it. And for the privilege of borrowing your money, they're paying you a paltry sum of interest, but they're also keeping your money safe because the Canadian government's like, I don't know, up until this year was like, pretty sure you're going to get your money back. I don't know. They must be out billions. I have no idea. Holy crap. So anyway, that's how you receive interest, right? So corporations, this is really easy. If they're owed interest, they just recognize it on an accrual basis. The corporation, the accountant at the end of the year is like, yeah, we're owed X amount of dollars in interest. They base it on whatever the principal amount is that they've lent out, and then the amount of interest they should be receiving. They accrue it. They'll go debit interest receivable, right? Credit interest revenue. That's what they do at the end of the year because you're required to under Canadian GAAP, generally accepted accounting principles, also IFRS, International Financial Reporting Standards. So corporations are required to accrue. So they accrue, even if they haven't received it, you set up receivables. That's the accrual method of accounting, guys, right? It takes into account if earning and spending money in a period, even though if the actual money hasn't gone anywhere, thus the difference between income and money. Now, individuals, it says they have 3 options for reporting interest income. So when I put this slide deck together, this was 4 years ago now, and there are better ways to explain this. So I'm going to try and explain this in a better way, and you'll have this recording for the rest of time, so you will have a better understanding. It says there's 3 options for reporting interest income. The receivable method, meaning, at the end of the year, you accrue the amount of interest that you're owed. This would be difficult because most people, if they've lent out some money to whomever, they need to know exactly how much the interest receivable is going to be. And that's not always that easy, right? It's doable, but you could technically accrue interest at the end of the year. Okay, so cash method, hey, I received interest, I'm just going to report it, right? But these are both governed by the following, which is the anniversary day accrual method. This is the one you care about. If I lean into the mic like that, does it go louder or does it go softer? What happens? It's a new microphone. Bad loud? Too loud? Should I just do them all like this? I'll just talk like this. No, okay. So guys, anniversary method. That's the one that you can. Oh, I don't know how that works. I've heard of that. Oh man, that's so funny. Okay. Guys, we're going to focus on the anniversary day accrual method, okay? I'm going to make life easy. Just here you go. It's not very hard, I don't think. So it says you have to consistently use this. God, that would put you to sleep quick. Yeah. Does anyone else use podcasts to go to sleep? I do. I just like hearing that voice, just like in the background. So I thought about this the other day, guys. I could do a tax podcast. Every week I'd do like 45 minutes where I talk about tax, and then people would get it in their podcast feed and they could listen to it and they might learn things and they might drift off to sleep. Yeah, Carly, I listen to a lot of true crime podcasts when I'm like tenting out by myself or like hiking in the fog. I find it like super I don't know. Just like sets the atmosphere. It's so fun. Okay, so look, cash method, just include an income in the year received. Big whoop. All right. Receivable method. This is where you would accrue in income when the amount is legally due and payable. That's fine. The problem is that, let's say you lend somebody some money and it's not supposed to be paid for 5 years, right? Like they'll pay you back the principal and they'll pay you back all the interest at the end of 5 years. What's the problem with that? You have earned income over those 5 years. You just haven't been paid it. So what you have to for tax purposes is accrue the income, and you have to accrue it. Like you can wait to accrue it, but you are forced to accrue it at the very latest 1 year after the date that you initially lent the money, right? Or you purchased the bond, which is lending money. Okay. So you've got a year to accrue things. I got an example somewhere. So here's the anniversary day accrual method, right? Interest income has to be recognized for every 12-month period from the date the investment was made. So when you make an investment, this I find amusing, and I shouldn't, but I do, is that sometimes people will be like, oh, I'm borrowing or I'm lending some money, and I lend money on January the 12th, and then I'm going to report interest income on January the 12th. How does that work? Interest is a function of what? Interest is a function of time. Thank you, Tristan. It's true. It's a function of time. If no time has passed, you don't earn any interest income. Correct? Correct. Likewise, if you borrow money, you don't owe any interest the same day that you borrow it. Although with all those subprime mortgages and stuff that were floating around in the States, oftentimes that was the case. Oh. Terrible times, guys, in 2008. Thankfully, you were too young to remember them, but boy, oh boy, people were stressed out. So every 12-month period, guys. So this means you can only defer the accrual of interest for a limited period up to a maximum of 12 months. I think I've got something. So if you haven't accrued, you have to accrue after 12 months. So here is an example. And if we do one or two of the, I think we can do really quickly some of the problems. So we got taxpayer X, they loan 100 grand to a business on February the 1st of 20X1. I did 20X1, so I didn't have to update the slides. Loan has to be repaid to taxpayer. Having that X and 20X1 is like stupid. I can see now. I should fix this. The loan has to be repaid to the taxpayer in 2 years. The interest is charged by the taxpayer at 12% annually. Wow, this guy is a loan shark. This guy is for sure organized crime. 12% and is payable at the end of 2 years, okay? So this is how this works. All it is a taxpayer loans 100 grand to a business, and he's like, here's the 100 grand. You need to pay me 12% per year. It is not due. Taxpayer will not get money until end of 2 years. The question really is, well, how often is this guy accruing? When does he accrue? And how often? This is taxpayer X, by the way, right? And I'll change this. It's so stupid. I'm gonna make a note. Change taxpayer X. Oh man, my videos for 375 are so much better than these videos. They're so old though. Okay, so cash method. Look, here's what's interesting: is the cash method is like, okay, guys, when do you actually get all the cash, the interest? Is it at the end of 2 years? So it's like 20X3, right? So let's see. Year 1, you're reporting nothing because you don't get any cash. Year 2, you also don't get any cash, right? So in 20X1, December 31st, you haven't received anything. By 20X2, end of the year, you haven't received any money. In 20X3, you get the money, right? It's going to be, and we're not compounding interest in this course. Why? Kathy has a bunch of interest compounding things. What the fuck? Okay. So look, $100,000 times 12% is $12,000. You add that up, you get $24,000. The total is 24 grand. Guess what? You're not allowed to do this for tax purposes. You're not allowed to do it for accounting purposes. You're not allowed to do it. But that's how it would work if we functioned in like a cash basis for tax purposes. All right, let's take a look at, this is just flat out the accrual method. Okay, if you were to accrue. So in year 0, this is accrual. You know what? Here. Accrual anniversary. Okay. I know it's confusing. I didn't do the greatest job of this one. I'll fix it at some point. Okay, blah, 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 blah. So under the anniversary accrual method, right, whereby you have to accrue after 12 months. In year one, which is 20X1 here, 2011, 2021, whatever you want to call it, you borrow the money, or sorry, you loan the money on February the 1st. As at December 31st, there is no doubt that you have earned some interest, but you don't have to report it this year because you can wait a full 12 months until you accrue it and report it. So in year one, you would have nothing, right? Because you do not have to accrue for 12 months. And should you defer it, guys, this is income tax. You want to defer everything for as long as possible. So if you can defer, in this case, you can. Now, the first time you would have to accrue is on February the 1st or January 31st. I don't care. Of 2002. Now, for the year 2002 or 2012, whatever you want to call it, year two, you need to accrue a year's worth of interest and report it for that year. So here's how that works. There's year two. The 12,000 is 100,000 times 12% for an entire year. You could, if you wanted, accrue at the end of year one. If you wanted, you could accrue the 11 months of interest if you wanted to. But why wouldn't you wait till next year to report it? Maybe you're in a lower tax bracket this year and you're like, I want to report as much income as I can. So you might report it this year. But for the purposes of this course, you're always going to wait until the anniversary date. So year three, you're also going to report 12,000 bucks. Guys, when do you get all the money? All the money comes in year three, right? But you report the interest in year two and year three. This is the required method. Now, could you accrue it sooner? Sure, you could go year one, you could accrue 11 months. Year two, you'd have 12 months. Year three, you would have 1 month. But you can see how that shifts forward in time your payment of tax on interest, which, why would you want to do that? Leave it to your estate or something. I got to fix the lighting here. Whatever. Okay, so deductions from interest income. Guys, if you're earning interest income, it's possible for you to take some potential deductions. Did you borrow money to buy interest-bearing securities? Okay, then you can deduct the interest. So you're going to have interest income, and then you'll deduct interest expense against it. Right? I borrowed money to buy government bonds. I earn interest from government bonds, but I borrow the money. So my expenses, I have interest expense to offset that. If you borrow money to buy government bonds, guys, you're going to have a net loss. Your government bond is going to pay you like 0.125%. If you buy the best government bond, maybe it's 0.5%. The interest that you're going to pay the bank is going to be like 6% or something stupid. Investment counseling fees. Did you go to some... Does anybody here work at a bank as like an investment advisor? Because you guys are all probably qualified to do so. Those people don't know anything. Rarely, okay, never. They're never qualified accountants. They're usually people out of high school who've taken some kind of like lazy security course for 3 months. They don't know anything about investing. They're just trying to sell you the products for their bank. Why am I whispering about this as if it's some big trade secret? So look, if you're paying some investment manager to manage your money, okay, you can deduct that against the income that you have. That's fine. Just remember you're paying them fees too on top of their little counseling fees. So investment counseling, investment management. So there's investment counseling. You go in and talk to someone and they tell you what to buy. And then there's the management fees that you pay, which is for somebody to like actively manage your money and like put it into this stock, buy low, sell high. That's what they try to do. They can't beat the market any better than you can, right? Just so you know, but don't take my word for it. There's a lot of books on it. If you want some suggestions, I have like a reading list. Fees paid to a financial institution to hold securities. Okay, so if you're paying bank fees, you can deduct those. Accounting fees you can deduct here as well. This is fantastic news. Any expense that you incur to earn interest, you can deduct. Oh, good. That's it for this interest thing. Shoot. God, we got like 10 minutes left. Do you want me to do a problem real quick or do you want to ask questions? What do you want to do? And don't feel like you have to stay. If you've got like a lunch date, you should go on that. This could be the one. So you should go. You can watch this later. What do you want me to do? Do you want me to do a problem or do you want me to answer questions? You don't have to stay. I'll be fine. Nobody has an opinion. What are you guys doing right now? Nobody's listening to this, so what are you actually doing? You catching up on, I have no questions, so yeah, problems. Can we go over problem? Yep, done. Okay, 2 people weighed in, and it's 2 people who are chatty people, so I'll do what they want. Here we go. We're going to do, from the course pack, we'll do problem. Look, I'm just going to start with problem 1. We'll see how far we get. Here's problem 1. Can you read it? We got, what the, okay. Miss Susan Skapanska. I love this name. Shipanska? What is that? Polish? I have no idea. Received $1,900 in eligible dividends from a Canadian public company and $1,200 of ineligible dividends or non-eligible or other than eligible from a Canadian controlled private corporation, CCPC, during the calendar year. In addition to the dividends, Mrs. S, that's probably the way to go, has a $12,000 3-year bond purchased on November 1st of this year. The bond earns interest at 6% per annum with interest paid at maturity. So that means interest is going to get paid in 3 years. But we can't report it in 3 years. We're going to have to report it before then. Okay, so costs incurred by Mrs. S during the year include investment advisor fees of 500 bones and interest charges of $200. Susan owns rental property that generates rental revenues of $8,000, incurs cash expenses of $4,500. Maximum CCA is $4,000. You don't have to calculate CCA. So what's her net investment income for the year? Well, let's see. Boop. I'll leave the problem up here like so. Like so. Key. And then I'll bring up, I prepared some stuff here. Okay. Nope, wrong one. Boom. There it is. Okay, so I've prefabricated these things. Oh, I should have done an intro so I could have sliced this up. Hey guys, welcome to the Accounting 240 run through of problem 4.1 from the course pack. I've already read the narrative, so here's the solution. We're going to start off with putting in some eligible dividends here, guys. Okay, so we've got eligible dividends of $1,900. And this is, look, this is exactly taken from your course pack solution. You wouldn't have to write it out like this necessarily, but you know, it's a good enough setup. So I write in my eligible dividends. I'm going to reveal this right here. And if I reveal this, it's 1.38. We gross up our eligible dividends by 138%. This is the amount right here that will be included in income. I'm going to try and make this a little bigger. Yeah, that's better. I'm still working out, you know, how to become an effective presenter in an online environment. Up to this point, I feel like I'm fairly ineffective. All right. So this is the income that we have and we'll report on our eligible dividends. Now our non-eligible dividends, the gross up rate on that is 1.15. Agreed, agreed. So I'm just going to punch in, what was that? It's $1,200. Here's the 1,200 right here. There it is. Okay, good. So far I'm doing pretty okay here. I've got my eligible dividends. Now I've got some interest income that I want to report. Well, that'll be fun, won't it? And you don't have to lay this out in this particular order. This just happens to be what I did. So interest income, I'm going to have how much? Do you guys know? Have you know about this? Did you hear about this? Okay, because we loaned the money in the current year, the anniversary date is next year, right? It's next year, meaning I don't have to accrue and report any interest this year. My interest income is 0 for this year because the anniversary date is November 1st of next year. Yeah. Yeah. So $0 of income. Now I can take some deductions from my property income. So far, my property income looks like it's $4,002. I got my investment counseling fees, 500 bones. I paid some interest on money that I borrowed to purchase my stupid shares. So now I've got 700 bones. Okay. That's going to be a deduction. Now I'm going to work out what my rental income is. Okay, that's also property income. My revenue for the year was what? 8,000 bucks. My expenses for the year, independently of CCA, are $4,500. Okay, look, I already pre-populated this, so it would go a lot faster. So now I just got to deduct. So far for rental income, I've got $3,500 of net rental income. I now need to consider, well, can I deduct CCA? And I told you guys never to deduct CCA on rental property. But let's say that Susan is an idiot and she insists on this. Believe me, I've had clients who are like, wait, there's a deduction I can take and you're not taking it? Take it. And then I'll be like, well, there's a lot of reasons you don't want to do that. And they'll be like, I know better than you. Where did you go to school? Nah. Deduct it. Like, all right, lady, whatever you want. And then I deduct it. So if the client insists upon it, they're technically the ones who are in charge of their own tax return. So, okay. So in this case, we're going to deduct CCA. Now, how am I going to calculate CCA here? Well, what's the maximum CCA? Here it is. It's $4,000, correct? How much can I actually deduct of that $4,000 from my net rental income? I got to get some music cues. I got to get the Jeopardy thing. Katie wins the Jeopardy match against Ken Jennings. Okay, so 3,500 bucks. Tristan, I'll answer that in a second. I need to finish this. So the CCA that I'm going to take is the 3,500. Boom, there it is. Here's my income before CCA. The max I can take is 3,500. My net rental income is 0. Therefore, my net property income is a total of 3,302. That's the answer to that one. Great job, guys. So that's where I'm going to edit this. All right. And now we can talk independently. So Tristan says, if you had CCA on an exam question, would you want us to include it or exclude it? Or would it be specified? I would have to tell you that this client is a moron and they want to deduct CCA. I think I should just be able to say, keep in mind your client is a moron. No, your clients aren't morons, guys. I mean, that for me to say that is just me being a smartass. They just don't understand tax, which is why you're a valuable individual. Okay, so you can gently explain it to them, and if they don't agree, you'll be as insistent as you can. And if they still tell you to take CCA, you'll say, okay, I don't think this is a good idea, but you're in charge. Okay. And so I would, Tristan, I'll stipulate. Okay. Otherwise, make an assumption and move on with your day. I got a couple more minutes, so I'm going to do problem number, I hate problem 2. Problem 2 is fine. It's boring. Problem 3, because problem 2 is the same as problem 1. Problem 3 is like, I'll never ask you this in a million years. I'll do problem 4. Okay, and that's the last one I'm going to do. But Kathy's done all of these, so go watch the Kathy Ross Video Express. All right, she's got a green screen. She puts in music, she's got some high production values. She uses a Mac. I don't know what that is. So we're going to go to problem 4, guys. Oh my God, there's so much stuff here. Ooh, I love the names. Good job. Good job on the names. So we got Siddhartha Sarano. Isn't Siddhartha the name of the Buddha? I think it is. So we got Siddhartha Sarano. You got the Italian Buddha here. Has the following income in 2020. You know how we generate names, guys? There's like a online random name generator, and you can put which ethnicities you want to include, or you can just put everybody in there. And so it will come up with weird names that are like this ethnicity first name and then random ethnicity last name. So you have like Icelandic first names and like Korean last names. It's the best. So here we have an example of that. Following income. Oh, wait. Hey, everybody. Welcome to the Accounting 240 virtual meeting walkthrough of problem 4.4 from the course pack. So we'll start out by reading the narrative. We've got Siddhartha, who has the following income in 2020. What? Oh, yeah. So it starts out by saying in 2019, this is poorly worded, but in 2019, he purchased a bond. There's a reason this is in here, okay? On October the 1st, the bond pays interest at maturity on September the 30th in year 3 at a rate of 3% compounded annually. Guess what, guys? The anniversary date is 2020, so we're going to have to report some of the interest income. He purchases a $50,000 bond on its issuance date of October 1st, 2020. Okay, we don't have to read any more. We don't care, right? Because there's not going to be any interest to report in respect of that bond in the current year because he'll report that next year. So just leave it. Then he receives $100,000 of eligible dividends. and $40,000 of non-eligible dividends, he receives $1,020 of dividends from a foreign corp. And then look at this, 180 bucks worth of foreign tax was withheld by foreign corporations. It's the total $1,200 of dividends. Okay, this is great stuff. All amounts have been converted to Canadian currency. That's important too. So you don't have to times one number by another number. That's hard work. So we've got Siddhartha owns a residential rental property as well. Of course, he's got all the kinds of property income. In the current year, he received rent of 60 grand and incurred the following expenses. Mortgage interest, whoa, 40 grand, property tax, that's not unusual. Insurance and repairs. At the beginning of the year, the UCC was 340 grand. Okay, guys, we're just going to calculate the property income for 2020 and then we'll be done. So again, I've sort of just bastardized your solution for this. And here it is. So first up, we've got the interest on the first bond. Well, it's going to be, oh yeah, because that's from 2019. So we're going to calculate 1 year's worth of interest. He purchased the bond in 2019, meaning this year he has to report 1 year's worth of interest on the 2019 bond. So I'm just going to punch in 40 grand because that's the principal amount. It's going to get multiplied by this 3% over here. Note the 3% off to the side. That's $1,200. That's what has to get included because it's the anniversary date. The interest on bond 2 is 0 because he purchased it in the current year. So we don't have to record any interest this year. Next year, you would have to do it. I think I wrote some stuff here. Let's see. Yeah, there you go. So it's the anniversary is in year 2, therefore no interest accrual in the current year. Awesome possum. Eligible dividend income. So he's got eligible dividends of 100 grand. I'm going to punch that in right here. Boom. Look what happens. Here's the gross up amount. It's $38,000. If you were to times 100,000 by 1.38, you would get this number right here. You would get 138. This amount here that I'm showing you guys in a lovely lime green, that's the actual gross up amount. This is the grossed up dividend. So you want some tax terminology? The $100,000 is the actual dividend. Okay, this is actual. The $138,000 is the taxable dividend because that's the amount that you're going to get taxed on. Is this clear? I hope this is clear. Actual taxable is 138. That's what you pay tax on. So we'll do the same thing for non-eligible dividends where we have 40 grand. And it's pre-populated. So the gross up at 15% is 6 grand. And now I've got $6,000 here. And that's the taxable dividend. This amount right here in the lovely lime green is our actual gross up amount. So I'll write that in gross up amount. That's what you would call that. Is good, is good. What? Get out of here, dude. So embarrassing. I don't know how that happened. I'll edit that part out. I probably won't. Okay, so we're back to what we were doing here. All right, so that's the gross up amount is 38,000 bucks. And the gross up amount down here. Gross up amount is 6 grand, okay? What's important is the numbers in yellow, right? The numbers in yellow are all amounts that are property income that has to be reported. Okay, so our foreign dividends, what the hell is this? Yeah, I got it. Okay, so the foreign dividends, we had 1020 with the foreign dividends. That was the actual amount of the dividend, right? That was received. Pardon me. The yeah, the actual dividend received, the taxable component was 1020. So I'm going to put that in there. 1020. But this is the gross amount. This is the net, all right? That's net. This is the foreign tax right here. This is the actual taxable amount of the foreign dividend, is 1,200 bucks. Okay, you need to include the gross amount, the amount before taxes were paid, okay? Okay, so then I'm gonna deal with my rental income. Rental income is 60 grand, and then I just have all this other stuff I gotta punch in, like mortgage interest, property tax, Insurance is $5,000. We got repairs, which is $2,000. And so I think, did I miss anything? Oh, CCA. Should we calculate CCA? Sure, we should. Okay, so this is before CCA. Before CCA, it looks like I've got $6,000 right here of rental income. So I think I can take up to $6,000 of CCA. So I want to calculate CCA. I know that my UCC was 340 grand. And again, this person has, Siddhartha's like, you know what, dude, just take the CCA. I need the deduction this year. I'm cash negative. I need to pay less cash out. So I'm going to punch in, shoot, sorry guys. Oh, that's so annoying. Okay, so 340 grand. So $340,000 times the rate, right? This is the class 1 rate. Okay, see, Katie, I did my best. This is bonus time. Class 1 rate is right here, 4%. And so the amount of CCA that can be taken is actually greater than that, I think, isn't it? But you're limited to $6,000. You're limited to $6,000. What is 340,000 times 0.4? Let's see. That's going to equal this star this. So that's, look at that. This is like the max CCA calculation. But you can't actually deduct that because you're limited to $6,000. Because look, I got $60,000 of rental income. I got $60,000 now of expense, including my $6,000 of CCA, which means here's my total rental income. It's $0 right here. So how do I get my total property income? Well, it's 1,200 plus 138 plus 46,000 plus 1,200. Kaboom. That equals this amount right here, 186,400. We did it, guys. Guys, we did it. So look, we're at 227. If you want to ask some questions, go ahead. That's fine. But that is the end of chapter 4, problem 4. Hey guys, thanks for watching this video. Did you find it helpful? Well, there's plenty more videos for you. Check these ones out right up here. And if you really found this helpful and you want to be updated of all the latest videos, why not hit subscribe? It's that button right over there. Check it out, guys. See you next time.